Hi everyone, welcome back to Be Rich. Happy New Year. A lot of you have been messaging me on Instagram and Twitter and LinkedIn, but I was off. I usually during the New Year Christmas break, I take time off from all social media platforms and work, spend time with my kids, and you wouldn't have seen me replying to most of your messages on Instagram and Twitter, on LinkedIn. I'm sorry for those of you who are expecting replies. But in the next coming week or so, I'll catch up. I've been flooded with lots of messages, lots of wishes, and I wish all of you. I hope you had a wonderful new year and a safe new year and are doing well. And it is quite tragic to see the things which unfolded in Japan, especially with the earthquake and the accident with the airport. I hope they're doing well and they're recovering, and our friends in Japan are doing better. Other than that, what did I want to talk about today? I want to quickly look back at 2023 and touch upon on 2024 what to see forward. I'm not an astrologer and I'm not claiming to be one, so I can't predict what is going to happen in the coming year and how it will be. I do not know, but there are some indicators which we can talk about. Based on especially the past indicators, we can see what future indicators are there. Look at the stock market, the Sensex and the Nifty 50 compared to gold. The Nifty has given around almost a 20% return for the year, and the Sensex has given around 18%, while gold hovered around 14%. So what is this main reason? We did start the year with a lot of gloom. We did say the Ukraine war, and at the time Israel hadn't started as yet. Now the Israel conflict also is there, and the oil and the global slowdown, the recession, inflation, this, that. We had so many things on the negative side, and most people, including a lot of experts and subject matter knowledge holders, said that it's going to be a tough year. But at the end of the year, lo and behold, we are here. The year is over, and we've seen this remarkable return in the stock market. So why is it so? Where did the experts not see what was happening, or why were we not able to see what was coming forward? That's because, one, the speed and the recovery of the economy was a lot faster and a lot more robust than many experts expected it to be. Post-pandemic recovery has been boosted by corporate earnings and investor confidence is sky high. So the economic recovery has been very robust in India. So that has been a big push, thrust forward. Second, which I would say is the FII's belief in India is also testament to our economy. There's been a huge inflow of FII funds into India. There are two factors to that. One is global. FIIs don't have many places in the world right now where they can park their investments. And two, of course, India looks like a shining beacon right now in the global landscape when it comes to investing in the stock market. Three, the domestic institutional investors, the domestic retail investors have been investing very heavily in the Indian market. There's been record IPOs, and there's been record new accounts being opened, mutual funds being invested into. So all this extra cash flow, funds flow into the stock market has pushed further growth. Four, I would say it's a slowdown and sluggish growth in China. There's been a lot of trouble in China this year. Their real estate sector's having a tough time. Their economy is having a tough time. And even in the presidential address, their president had acknowledged in a roundabout way that they have some economic headwinds ahead of them, which they have to manage. So that has also helped pushing Indian equity markets higher. Indian growth prospects have also been high because of our expectations in the Indian economy. Growth has been an attractive investment. There's been great proactive policies from the RBI, which has pushed our equities and making it more attractive this last year. And government reforms, policies which are aimed to ease growth and do business in India has also pushed stock market higher this year, which, yes, is expected. Most governments, especially when the election cycle is coming in, would try and push the economy and try to bolster the economy further. And the Indian economy's appetite for risk and risk riskier assets in equities has also ballooned. We see a lot more investors willing to take hedge bets and take larger risks in the Indian stock market, which we have seen in the small caps, especially this year. So that is also a big push for the market. And the last thing which has really pushed this market over the edge, over the top like this is the strong quarterly earnings. In sectors like pharma, FMCG, and realty has shown robust earnings. And yes, there is a K-shaped recovery happening in India. The rich are getting richer, and the poor are not seeing the kind of wealth creation the rich are seeing. But the problem also has its own solution in it, in the sense that the Indian population size of being 1.7 billion, 20% of that is the people who are sitting on the top of the K, recovery, and that is a huge market, and that is generating huge amounts of wealth. And that is attracting a huge amount of investment into India. And most of the recovery you've seen in real estate has been in that also. The high-end apartments, the high-end villas, the ones which are really in obscene prices are the ones which are showing tremendous growth. Even in cars and automobiles, it's the higher-end cars, which shows again it is a K-shaped recovery. What will happen going forward, I do not know. I can't see a K-shaped recovery like this being sustainable. Some policy change has to happen, or some economic headwinds have to change in such that there is some kind of equilibrium this coming year. If this kind of K-shaped recovery continues on for the entire year, I do not know if our markets will be able to sustain this kind of velocity. Second thing, this coming year is we have the elections. FIIs and most investors prefer having stability when it comes to investment. And the first point of stability is ruling. When the government is in majority, then you are very sure on the policies and the vision forward for the country. I'm not in any political allegiance. I'm not like my brother. I do not say this party or that party. I'm saying as purely as an investor, we look for stability. So whatever the result is, if it is a majority result, it's much better as an investor than to have a hung parliament. So that is something to watch. All indicators seem to be pointing at that we'll have a majority in government this coming election. So that kind of euphoria should be continuing in the Indian market. And the third point is the dollar and the Fed, what they do plays out on a macroeconomic level globally. And it, of course, has implications to us in India because we are an open market. So people are expecting the Feds to cut interest rate going forward, that there's enough room for the Fed to cut interest rates. That joy and buoyancy is also predicted in the market, and that euphoria might spill over and push the markets higher. I hope that this year is a productive year for all of us as investors, and I always urge all of you to be invested regardless of the market, because we are long-term investors. These kind of euphoric years come and go, and we might even have a few years where instead of seeing 15% growth, we might see negative returns in the market. It's happened. But if you keep investing in the long term, it all averages out and you should be fine. And these kind of fluctuations in the long term tend to iron out. It's like zooming out of a map. As you zoom out further and further, the coastline, instead of becoming rigid, it turns smoother and smoother, the coastline. Same way, all of our returns will also even smoothen out if we are invested in the long term. There's just intellectual noise which we're discussing, what happened in the previous year, why it happened, what could happen in the coming year. But as an investor, you should always be invested. Thanks for watching the video today, and I'll see you in the next one soon. Bye.